All right, what's going on, everybody? So today, I got a very special guest, Faisal, who's been on our calls before to discuss things regarding the stock market, the macro picture, and then future outlook of stocks. And so today's video is kind of exactly along the same lines of, first of all, it's been a pretty long year for everybody. We're in the last quarter of the year. I wanted to bring Faisal on to get the idea of, first of all, where he stands in terms of the market, how things have been, how he's trading the bear market conditions right now, strategies that he can outline for you guys. And then a bulk of the time, I wanted to spend on just looking into the future, because obviously the present right now has sucked for a majority of people, whether you're in stocks or equities or bonds, or if you're a gold bug or whatever. Really, there's no place to hide, right? So that's what I brought Faisal on for today. So let's get into it. What's going on, man?
Not much, man. Good to speak with you again.
Yeah, it's been a while. So listen, man, let's dive right into it, right? I want to talk about, first of all, how's your year been? How's the trading and investing been in the market?
Oh, I think my year has definitely been better than what I've been seeing online, and that's the result of me kind of adapting to the environment. Interest rates going up so much has created so much volatility, not only for stocks but for assets across the board. And I've never had to day trade or like do a single day trades more so this year than I have ever before. Like it's just been like in and out of trade so fast. You kind of have to have conviction going in, but really tight stops. And I don't use stops necessarily, but it's kind of like basing it off of short-term theories, where I think the leadership is, if things can hold. And for the most part, I think this has actually been very tradable for the past 3 months. It's I think the first half of the year was much more brutal. It felt like there was partial denial that it could get this bad, but I think the past 3 months, it's been pretty tradable, to be honest. There's been leadership groups in energy, and now we might get some in the financials. So there's definitely pockets of places to invest in, but it just feels like you got to stay on your toes. Like you got to keep navigating and seeing, okay, let the tape prove what's working, and don't really think too much otherwise.
Yeah. So a couple of things that you brought up, definitely the last 2 or 3 months have been a totally tradable market, because you kind of get these areas of support and resistance that the market cleanly accepts or rejects. And so you get these clear opportunities to buy into the flow or get out of the flow, right into key areas. And this is not only prevalent for equities. What I've seen, it's been happening in crypto as well. So it seems like the flow itself of how the money has been rolling into the market or coming out of the market in key positions or key assets seems to be very correlated in my opinion, or what I've seen so far. The other thing that you mentioned was, the interest rate policy, right? So I want to dive a little bit more into that, because obviously first half of this year, I should say the first quarter, we all got punched in the face by this high inflation, Russia-Ukraine issue, and then lifting off the ZIRP policy, the zero interest rate policy that we've had for almost 10 plus years. And it's been interesting because after the 2007 and 8 crisis, just to sort of go back, the Fed sort of came up with this policy of easing monetary policy in such a way where it benefits the economy, creates loose monetary and fiscal conditions to sort of give businesses and banks to shore up their balance sheets and lift the economy sort of off the grounds of what happened 08 and 09. However, in 14 and 15, when they should have started to actually raise rates, they did not. They actually let it continue on to almost to the COVID crash. And after the COVID crash, they still kept rates low, and they flushed everything with liquidity, right? And this is where we get into the after effects of that, because effectively, I don't know if you agree or not, but they basically created an everything bubble. And now we're seeing the consequences of the liquidity drain out of that everything bubble. Do you kind of agree with that?
Oh yeah, totally. I think in the beginning, I used to think that it wasn't necessarily a bubble. It couldn't be classified as a bubble because I think these were really strong companies that were growing their earnings. A lot of them were growing their earnings up, and then also a lot of them in the software space and high growth space, they were unprofitable, but their revenues were growing and everything like that. These were not the .com companies that had exploded, even though the price action kind of looked the same. I never thought that it would kind of pop the way it did, but going back to it, one lesson that I definitely kept from that was, yes, everything that was high growth was super expensive, and there was really no standard as to what was like fairly expensive or just out of the moon expensive. But going back, I remember looking at all the PE ratios of stocks like Home Depot, Apple, Microsoft, and they were all at 5-year highs. And so I think next time, if there's ever, a type of question where if we're in an asset bubble or not, that's what I'm going to be looking for, because there's always going to be these high growth stocks that get bid up because there's easy money. But when you start seeing the leaders trade at historically high multiples, I think that's when okay, this is probably a bubble.
Yeah. And one of the things that sort of defined that was, we spoke about, first of all, the big bang that sort of came out of this 2020, 2021, pop and everything. For example, real estate across the board in the United States was up, I think, 30-40% across the board, which is well beyond historical norms. It's not like most people living in America, their house just got spontaneously upgraded, right? Like their house should not have seen a 30-40% value pop, but it did. And I think part of that was, yes, it was excess liquidity, but more so was, currency debasement. That's kind of how I saw it. And now that the Fed is trying to peel back that liquidity, housing, stocks, crypto, all that stuff is, the air is being sucked out of the market. The music seems to be slowing down, as people in margin call referred to it. And one of the key cases of watching and looking back on that was IPOs, right? And then you and I talked about this on the call. Like, we can't really remember what are the 2022 listed IPOs, because I, first of all, wouldn't be surprised if majority of them are down, pretty much on the year. But what I can remember, say, from 2019, 2021 was things like Palantir, or companies like Peloton, Lyft, DoorDash, Robinhood, GameStop era movements, or AMC. And all this stuff came about and is now sort of giving us the idea that, okay, maybe the market now is coming to its senses, where all things that are, let's just say, trading at historically high PE valuations, or companies that are not making money, this may be sort of the death knell for them over the 1 to 2 year bear market. First of all, like, do you kind of agree with that the bear market will be prolonged a little bit longer? And do you agree that this might be that cleansing cycle that we really need?
I'm kind of in the camp, and I don't know if there's actually a camp for this, but I think the bear market will be marked by some type of event. It could be when the Fed starts to maybe change its tone on rates, not necessarily when rates start to go back down. It's going to be marked by something, and I think until you get that tide turning event, it's like the unlimited ammo event. Until you get that turning of event, I think valuations can go anywhere. I think just like they went up, so much they can go anywhere up. I think you could literally have stocks that, let's just say Apple's historically at like a 22 PE. It can go all the way to whatever, 13, 14. I don't even know. I just think it's all marked by, where we are in the time and place, and just all of these macro events coinciding together. It's just, you have to wait for that capitulation event or that tide turning event. And until then, I think it's very likely that the market will overshoot all types of valuations, all type of historical norms. Like, the overshooting, I think is bound to happen for sure.
Yeah. And I kind of agree with you there. And I think the other thing I want to sort of tie back into this is, I believe that, so I agree with you that the Fed pivot at some point will likely come, whenever something breaks, right? Historically, it's kind of been big banks or financial institutions, failing. I don't know. Sometimes it could be like a government failure somewhere in Europe where
It honestly could be like the peak in inflation. Like I really am open-minded to anything. I think when you get some type of very pinnacle event, and you see meaningful price action behind it, that's when I think that we have hit the bottom. That doesn't mean we're going to go straight back up to the top, but I think that is when we've hit the bottom. Like for instance, I'm very open-minded to thinking last week's CPI report, that could have very well been the bottom. I honestly don't think so, but that's a big enough event to where, okay, the fear was extremely high, may not have been historically high enough to consider a bottom, but it was extremely high. It felt like people kept getting the rug pulled out from them as far as has inflation peaked. Personally, I thought inflation was going to show some peaking signs, and it didn't. The rug was pulled out from under my feet too, and it's going to take some event like that. And I think you saw that huge doji on that day, and so
yeah.
I'm open-minded to that being the bottom. But once again, it's all revolving around these specific events, and until we get those events, it's like kind of just choppy, volatile trading from week to week.
So I don't want to spend too much time on this, but let me push back on just this particular point that you mentioned, just because I think it's actually an interesting discussion. So I heard on a podcast that in the 70s, when there was almost to the point of, extreme, or let's just say hyperinflation, a similar policy change was actually enacted where the Fed did get into the, hiking cycle, where they were trying to press inflation down and, really exactly what we're doing now, which is raise interest rates to the point where money becomes expensive, bring the economy, maybe closer to a recession, as quote unquote soft landing. But then back then, what happened was the central banks or the Fed eased off, meaning they said, hey, it looks like inflation is, peaking, and we're probably going to stop because we don't want to bring the economy into a deep recession. And what followed that was an absolutely sort of, roaring rip of inflation. Like inflation actually doubled. I think it went from like 11 or 12% to 24 to 26%. And Jay Powell has actually mentioned this before, and Kashkari and all these guys have mentioned this before, because they stated that we don't want to make the mistakes of the 70s where we prematurely pivot or we prematurely stop hiking rates, because they're worried that if we ease off, then say the market or almost all things across the board may start rising again, and this would once again take inflation higher, right? So I just wanted to get your thoughts on that.
I definitely have. I mean, Jay Powell is a Volcker like disciple. He definitely believes in not making the mistakes of the past. And if he's got to go the extra mile to contain inflation, I definitely think he said enough to assume that he would. But I mean, and this is what's so hard, because energy has come down, home prices are coming down, everything, the shipping prices have come down, everything has seemingly come down, but inflation is still staying sticky.
Yeah.
And I gotta think, okay, Fed has raised rates. I'm thinking it's getting into the economy right now. Okay, they've been raising rates for, I don't know, 6 months. It should be filtering like right this second. And, as far as the earnings damage, everything, what they want to see, they want to see job cuts. They want to see all these things play out before I think they ease off of inflation, because I think there's not a better time to build up that inflation that interest rate protection that it's been missing for so long, than on an economy where it's definitely outperforming other economies on a relative scale. You have that ability to push the interest rate environment because employment is not budging. And I think we're still adding jobs, and I think that's a key indicator for the Fed. They want to see employment break. I think Jay has even said it the last time. He keeps citing the labor market as being extremely strong as a reason why he's pushing forward. So, I think,
I totally, yeah. With regarding your point about labor market, I find it really interesting that is something that he very viscerally understands, because he knows, he's like, I got to put the entire economy and people through the ringer to squeeze this inflation out. And basically what he's really saying, to not mince words, is he's like, I need to make everybody fucking poor, at least a little bit more poor, till we actually peel this inflation back. Because you're right. Like labor markets are the deciding factor of, first of all, productivity in the market, pulling back, or labor itself pulling that GDP back, which in turn would effectively mean inflation to start peeling back. And the fact that he is not seeing that, he's like, well, I got to keep going. Like, I might just, not hike 75 continuously, but I'll just keep this party, that the interest rate party at the highs as long as I need to.
Yeah, I totally agree. And I mean, this might be the best time to do it. I mean, just to build up that interest rate safety for the next time that there's a downfall or something like that, while the economy is still humming for the most part.
Yeah.
I don't see why he would want to slow down anytime soon. Definitely, there's some people that are saying he might not cut interest rates, in December, and I think that's a far shot. I think he might, probably end up going into 2023, early 2023, and then ease off sometime then, because I think that's when the earnings are going to be cut. The job site or the job openings are going to be just disintegrating, and the interest rates, all the high interest rates, will start really filtering into the economy. We're going to see those results.
Yeah. So with that in mind, let's sort of move on to, how do we position ourselves? We got the, last stretch of the quarter ahead of us, right? From my knowledge and, when I read about how Wall Street sort of understands markets in general, this is the time where most people do not start positioning themselves into trades, meaning they're not out there thinking, hey guys, it's been a shit year for the past 10 months. Let me just start buying, right?
I might have to push back on you on that. I think I've been hearing a lot of people mention that this is a historically good time to buy because of the election cycle. Towards the end of these types of election years, especially when there's a high risk of gridlock, I think people and traders are starting to position themselves somewhat positively, especially when we've overshot this much. That's definitely a theme I've been seeing a lot.
Yeah. So, okay. You know what? You're absolutely right. And I'm going to counter to that and also add to your point, which is, yes, on typically midterm election years, the market leading into the year, if it has been, let's just say, tremendously negative, right? Headed into October, November, and December, the market has actually rallied, if I'm not mistaken, 12 to 16% off wherever it closes out the third quarter, meaning headed into the last quarter of the year and into January the following year. It's been extremely surprising and almost like kind of a historical pattern to see that market rally into the midterm elections. However, the other caveat to that is, well, that rally actually starts to begin sometime at the end of September. Again, I sent you this data a while back. I'll have to find it for our viewers, but that rally starts to begin September and starts, moving into October. So let's get into the nitty gritty of it, right? Like, okay, well, do we then assume that, let's just say, going along with that midterm election thought process, well, then do you think that this area right here could be creating some sort of bottom?
Oh, absolutely. I think that's a total possibility. I wouldn't be surprised if it broke that low, but I think the market is absolutely trying to find a bottom here. Buyers are definitely trying to step in and hold key levels in that range that you just highlighted.
Okay, so you're saying that this low right here from last Friday or last Thursday could be broken, but we could still be range bound like that?
Sure. I actually don't even know if the top of the range has clearly been defined. It could be where that Fibonacci level, the mid Fibonacci level is, the one right above it. Yeah, it could be there. I mean, but I think the bottom is trying to be formed right now. I don't know where the top is. I think that's remains to be seen, but definitely the bottom is trying to be formed.
Okay, fair enough. So as you're looking at the markets to create some sort of bottom here, what are some strategies, like as you're heading into Q4, right? Like, what would you say that you're probably thinking about doing? And I want you to define it like two ways, right? Because obviously you and I can both trade on a small, short time horizon where we can get in and out of trades through the week, just because the market sort of, has been very choppy. And then we also have this long-winded view of, well, do I want to be a buyer of, I don't know, let's just say Netflix you were talking about earlier, or some of these growth stocks for the longer term? Do I start dollar cost averaging? So let's go on with, your short-term view.
Yeah, those are really great questions. I just gotta stay like just keep the odds more in your favor. And so I'm a secular guy. If the sector's doing good, I like to buy stuff in there. And so energy is one that has continued to be a great sector. I know you and I were talking about Oxy earlier this week. LNG is my top liquid natural gas play. Just anything related to energy because there's a catalyst behind it. As long as this war continues and supply is tight,
I think energy is probably the only sector that's up this year, huh?
I would assume so. There's agricultural products that are also doing really well, like CF, that make fertilizers and things like that, that I also really like too.
Yeah.
But obviously, broadly speaking, I think energy, yes, has been the only sector to really do good.
Yeah. I was gonna say, looking at XLE, XLP also looks good, the Staples ETF, but XLE, my God, that is, had you just positioned yourself long headed into 2022, you're good. I think you're up like probably 20% on the year versus everything else, which has been, kind of shit.
Totally. And to be honest, I don't think the trade is over. I think it's a overcrowded trade. I think it's an obvious trade, but when you have a tightening environment, and I was telling you this, I think 2 weeks ago or a couple of weeks ago, that it just reminds me of COVID and the software stocks, the stay-at-home names. Like when the environment gets tight, the upside for the safety plays, I think, is endless. And so just in the past couple of days, what I've noticed from price action is that oil has actually gone down. Oil broke a very key level yesterday that I was watching. And the funny part was none of the oil stocks actually broke down. And today you had oil kind of struggle in the morning and it rebounded just a little bit, I think up less than 1%. And you had these oil stocks, EOG was up like 3%, Exxon was up 2.5%, 3%. You're having these outperformance in the actual commodity. And I think that's a result of people finding safety in these companies. Not only are they cheap on historical metrics, like PE, but they also provide a really good dividend. And once again, they're working. They're the momentum plays as well. So you kind of have to ride the train as long as the external catalysts support it, the earnings estimates support it, and definitely the price action leadership supports it. So all three of those things make sense. And so that's definitely a trade I would stick with.
Okay, yeah, that's good to know for our viewers. Make sure y'all pay attention to energy. One thing I want to ask you is, what did you think about the Biden administration talk about dumping some of these oil reserves to try to sell, quote unquote, at the highs and buy lower? Did you think like that's a prudent plan, or did you I don't know if you were thinking along the lines of what I was thinking was like, what the hell? Like, are these guys trying to trade oil? Try to buy, sell high, buy low kind of thing?
I think they're just trying to pressure the price. If you have a lot coming on the market at one time, I think it drives the price down a little bit more. It's a little bit like manipulating the market, but I'm not smart enough to know, everything that's going on, nor do I understand the supply demand side enough. But I don't know. It seems kind of crazy to be trading oil, but if they can do it, if they can manipulate enough, that's the U.S. government. They can do what they want. So
yeah, I was gonna say I'm surprised the SEC is not going after Biden.
I know, man. Oh, that would be a case. That would definitely be a case to see.
So so energy is definitely an interesting sector that people should be watching. And we were talking about Occidental Petroleum, just FYI, for those of you who are watching. OXY is a ticker. So let's start getting into, first of all, what about like what's next, right? Like what do you think, aside from the bear market that we're stuck in? Obviously, as long as like the world doesn't end due to Putin, nuking Ukraine or anything like that, as investors, we should always be looking in an optimistic lens of what the future has in store. So what are you looking at nowadays?
Right now I'm just trying to find what are the stocks that are going to be growing in 2023. I look at a stock like TSM. It's been absolutely beaten up. It has legitimate concerns from China kind of invading and messing everything up, even though I think that's not going to happen. at least for a year or so, but who knows? I think a company like this might be close to bottoming. And I know you look at this chart, you're saying, how the hell could you think it's close to bottoming? I just
Yeah.
feel like the theme of it is like, I've checked out the earnings reports. Things are still great. This company is at the core of growth itself. If the world economy is going to even grow by 0.01%, TSM is going to be involved in that. TSM is going to grow in that environment, and their outlook is great. They got gross margin expansion. I mean, they're so far ahead of their competition. I look at a stock like that that's fallen, what, at its peak it was 150 and now it's like $60. I
Yeah.
look at a stock like that and I think, okay, it may not reach that 150 level next year, but I definitely think I don't know if I'll get a better price at this point, to be honest, considering it's still growing earnings so well. It's growing their margins so well. So TSM is one that I'm looking at. I also really like the banks. I think banks have been beaten down for a long time. Stocks like JPM and Bank of America, especially. These stocks have really underperformed, and I think a key thing to know, a key change in this cycle versus the upcoming one, is that I don't think interest rates will ever be as low as they were for the past 10 years. I think that is gone. Even when the Fed starts to reduce their rates, I don't think they'll go back to kind of negative interest rate or even 1% interest rate. It's going to stay at a roughly flatter level, especially if inflation is more persistent. So that in turn gives these banks a floor that was not present over the past 10 years. And so the net interest income that's coming over the last quarter, I mean, Bank of America talked about it, JPM talked about it. I mean, they are seeing record amount of money because of higher interest rates. And I think when you have a higher floor in that factor, these stocks should start to do well in the long term. Now, I still think that they can also come down just as hard if the market comes down, but once again, they're very well capitalized compared to previous recessions and everything like that. I think the recovery in these stocks, they could see a V-shaped recovery versus a stock like Apple could be range bound. Like, I think that's totally possible because of the factors that I listed before and the fact that they're so well capitalized during a recession.
Yeah. No, that's fair. I agree with you. I definitely think banks right now are better capitalized than they were in, prior to the 2008, 2009 financial crisis. I was kind of listening to the JP Morgan call, and they're not the call, but it was like, something regarding their earnings. They're talking about, investment banking side not doing so hot.
Oh yeah.
Seems like, yeah, so it seems like banks themselves are starting to realize that all their earnings that come from the actual, trading or iBanking side, those earnings and those revenues are being peeled back, right? I wonder if there's a play for, some other banks or some other institutions to come swoop in and try to take some of that revenue off their books. Like, what I'm trying to say is, the fallout that we were kind of looking at the past few weeks from Credit Suisse, do you think that there is some bank out there that is very sort of undervalued that you believe could be a very, very great play that really most people are overlooking?
I think JP Morgan obviously is really good, and I don't know if people are overlooking it, but the price shows it's gone down quite significantly. I don't know if there's one that's necessarily being overlooked, because maybe in the past 2 weeks or so, I think financials have kind of gotten hot. I've seen on TV and things like that, people talking about financials are the place to be. But I think the real revelation after, I think, last week and early this week of earnings is that the investment banks, just like you said, Goldman Sachs, Morgan Stanley, the ones that are more geared less to commercial banks that are less interest rate sensitive, those are the ones that are struggling. I mean, Charles Schwab, also SCHW, got whacked as hell because they got all these assets and equities and things like that have gone down in value. So yeah, I think it's more about just sticking with traditional banks, maybe even regional banks. I forgot what symbol, maybe KRE is the regional bank ETF. Those banks are not, investment banks. They're more commercial based and interest rate sensitive. So if you're someone who believes in what I believe, that we'll never go back to those low interest rates, then you have to account for the fact that this is a factor that was not present in the last 20 years when these stocks were underperforming. And I think it'll definitely be relevant in terms of how these stocks perform over the next 5 years, as long as rates stay above, 2% or, above what they were before, essentially.
Okay, fair enough. I wanted to, I guess, dive more into the future of, first of all, I'm a fundamental believer that all sort of, bad times, recessions, bring about some of the most unique and innovative technologies for the next era, right? One could argue that, almost all great companies have been created out of huge crises and shifts that have happened, like big paradigm shifts that have happened in societies, whether it be the internet bubble that we had that popped and brought about amazing companies, or 2008, 2009 financial crisis, where companies like Uber or Facebook were able to IPO. So this time around, right? Like, I have a certain way of looking at technologies, and I know you do too. But I wanted to touch on one thing, which is we went from, as humans, from the farmland to the industrial revolution, from the industrial to the office revolution, where most of us were working in offices. And so from the office, we're now going to the work from home lifestyle. So this seems like a new paradigm shift that's happening. What do you think will be sort of the outcome and companies that you may be looking at for the years ahead of this work from home environment?
Oh, that's such a good one, because this work from home theme, it seems to be like combative. Like, companies do not like you working from home that much, and I think I agree with you that that is the future, and there are more jobs being created that are remote. But I don't like that there's not this full-on adoption or just full-on acceptance of integration. Doesn't mean you got to go full-on virtual, but this hybrid workforce, it seems like there's still a lot of conflict between companies and how they want their employees to show up. So, I mean, work from home is definitely something that I'm struggling to figure out who the winners are and who the losers are. But I wouldn't say I'm a big metaverse guy. I think we're far away from the first metaverse type product. But you look at what NVIDIA is doing for the Omniverse,
Yeah.
and how they're training AI. I mean, that's the biggest thing in the world. Tesla, they're going to be number one in AI, in terms of AI driving, because they have all the Teslas out on the grid. They have them all sending information back to them that helps their algorithm become more efficient. I mean, with an Omniverse, and obviously it's, for Tesla's case, it's really hard to program a real life Omniverse because there's so many variables. But for what I've seen, the examples that Accenture has done, where they're trying to make like a virtual campus, or Lowe's is trying to make an Omniverse that is training their AI and also has some integrations that help their in-store employees. When I see these technologies being developed, I'm like, okay, like, people are going to be more efficient, companies are going to be more efficient, operating margins are going to go up, and this level of efficiency is just going to keep increasing, just like we saw in the past 3 years, 4 years, that margins themselves are getting so much better. Companies are finding ways to become more productive, even as they're hiring more, which is a crazy stat. I think productivity has gone down recently, but I think the trend is, these new technologies, I don't know how much NVIDIA is going to make from the Omniverse, but I do know that it will have real life impact on work from home people, and how companies do their operations day to day. So I'm really excited for that technology for sure, because it's here right now. Metaverse, maybe 10 years out. We need that first gear product to really get us in there, but the Omniverse is here. It's training AI. It's making companies more efficient, and I love that.
I definitely agree with you. I think the Omniverse concept that you mentioned for NVIDIA, I saw a video on it. Brilliant. I think is brilliant.
Yeah. Uh-huh.
Yeah, I think carrying on, with this whole sort of work from home concept is going to be, in my opinion, as crucial as it was for companies to pivot away from sort of that analog manual world to the internet world. I guess you could make the argument that it's not as critical to be working from home versus the actual deployment of the internet that happened. But the point is that in terms of a workers' revolution,
Yeah,
right?
I agree. I totally
I,
agree.
I believe this is probably one of those things where this will be etched in history as like a new paradigm shift of how, workers were able to basically, create jobs and create income from home. Productivity, you're right. I think they're trying to figure that out. Like, how do we keep employees like engaged and highly productive machines, if you will, as they're working from home? And I think from that will come about businesses that will do productivity tracking, such as software, such as, I don't know. I remember back in college, we used to have this
I know what you're talking about.
this
Yeah.
tracker where you could not go off the screen or something, or you
Oh,
could.
I hated that. Yes.
Right, exactly. So you're aware of that, right? Conceptually, like, okay, it makes sense. Like if you're at work, like don't be Facebooking or whatever. Do that shit on your own time, right? So I think those new sort of software, tracking devices or productivity tracking devices, could be a SaaS product, whatever it may be. I think that's going to be probably the next, big company. I don't know who's making it, but I'm sure someone is, right?
Yeah, I mean, to touch on two things, I think one, from what I've heard about that tracking software, it seems like companies themselves are making it. I don't know if there's a player that does it, but I know for Amazon, I think they have in-house software that kind of tracks how the drivers are doing. It's really strict, and I think that's another thing too. Like, I don't know if the tracking will become big because employees will definitely push off on that. And I think as long as the job market remains tight for top tier talent, companies don't really want to piss off great employees. I think for a certain level of employees, like obviously if you're a driver, Amazon versus a software engineer, Amazon, it's like different. I think they would track the driver because he has a lot less job security versus the top tier developer. But
yeah.
I think there's got to be some pushback on that. And I love what you said about, there's like this worker revolution. I totally agree with you that this work from home thing was like the first time people demanded, there's a lot of stuff about mental health, and whether or not you think that's a little bit exaggerated or not, like I sometimes think it definitely is. I think, working from home has helped a ton of people that I've seen in my real life. They're able to spend time with their family, get all their work done. And if you're still just as productive while being a happier employee, that's what a company should want. And I think that's what is a common sense idea in a lot of employees. And that's why they're pushing back. Like they should have that for sure.
Yeah, and in terms of just sort of assets or say costs on the company's behalf, well, if people are working from home, then that should mean that you have lesser costs from a commercial real estate standpoint. Whether you buy your
Sure.
employees lunch or pay them extra money to go on these trips for conferences or whatever, if all that can be done online, maybe that money can go back into the pockets of the employees. Probably not. It might just go back into the CEO's pockets or into stock buybacks. But
Probably,
nonetheless,
yeah.
right? Like it would probably be, a right step in the right direction.
For sure. I think the only cost that would be going up, and this is, I guess, one growth area is probably how companies secure that information that's not on premise. So cybersecurity, things like that, logging into third-party credentials, something like CyberArk that has you, oh no, that's VMware. VMware has like you log on to a virtual server. CyberArk, I think, has you log on to like a third-party credential, thing like that. So that's the only cost I can see going up by having employees go off premise. Other than that, you're exactly right. I think it's probably cheaper and everything like that. But definitely if you're for the work at home movement, I think cybersecurity is definitely on the company's top spending list if they're going to increase in that area.
Yeah. And do you want to just list off a couple of tickers and companies that we should be paying attention to for cybersecurity?
Yeah, there's a couple. I've talked about CrowdStrike, which is endpoint security. Microsoft is a very big endpoint security. CyberArk is like credentials, what I was talking about.
What are the tickers? Endpoint?
So what did I say? CrowdStrike, CRWD.
Okay.
That's kind of the most popular one. I think you've probably heard it a lot on Twitter. They have a really good CEO. They use AI for their endpoint detection. Okta is one that's beaten down. I don't recommend you touch it at all, but they have fantastic OKTA. Yes, they have fantastic assets. It's a terrible company. It's not profitable at all, but
I think I wrote this a
yeah.
while back.
Oh, yeah. I mean, damn, like, yeah, they're not going to be profitable for a bit, but they have fantastic don't take my word on it, but I'm pretty sure someone wants to buy them out. I think it's only a matter of when, not if.
Okay.
Zscaler is zero trust. I forgot what zero trust is. There's so many different, there's like 13 different industries in cybersecurity. Zero trust is like, I think it has to do with credentials as well. And then one thing I don't think is going to be good is if you have on-premise hardware associated with cybersecurity. So I think companies have already spent a lot on on-premise hardware. So Palo Alto Networks is also another very popular stock. PNW, they're more into networking and PANW, yeah. And they're a really good company. They've held up really well, but I think their outlook is a little bit shakier in my opinion because they have a lot of hardware sales too. So if I were to stick to one, I would definitely just stick to the one that has all software, like a CrowdStrike, Zscaler. I think CyberArk is okay, but definitely CrowdStrike is how I play cybersecurity personally when I'm trading it.
Perfect. Just FYI to those of you who are watching, full disclaimer, Faisal and myself may or may not own some of these stocks. We're not trying to shill you our bags. This is not financial advice. So just letting y'all know that we're not trying to, have you guys buy our positions.
I'm not going to sell it to you. Yeah. Don't worry about that. No.
Yeah. So, okay. So I want to go back to the whole metaverse theme. And one thing I want to make clear too is, I definitely think that we're kind of far away from that. Metaverse, I think, entails kind of AR, VR. And then I recently heard a term ER, which is like extended reality or something like that. Whereas AR is augmented, VR is virtual, ER is like the extended reality. So I do believe that these concepts are coming about, but definitely still, a little bit of a ways away, not only from the UX standpoint, but also from like the comfortness of how users can use these products and, put these, goggles and whatever on their faces. It is, it's definitely a little bit intimidating. I know a while back we saw surveys, like even the younger generation, a lot of them own this stuff, but like barely any of them use it. So it's like, okay, we have the technology, it's already out there, but like no one is using the damn thing, right? So I think there's a lot of improvement on that front that needs to be made. Other things that I do want to mark off my list, I personally am not like a big fan of 3D printing. I took my stab at 3D printing stocks way back in 2011 and 12. I think that was like the only time maybe they were a big fad. But other than that, I don't ever remember, 3D printing being a big thing. What about you?
Oh, yeah, I remember it. Maybe 2015, 2014, maybe 2016, one of those years. Yeah, 3D printing had its hype again. I fell for it too.
Yeah.
And it just amounted to nothing. It's really it's a very simple concept that I think grabs a lot of people in. It gets a lot of the retail investors in, but they're not profitable. They don't make money. And I think their business is super cyclical. There's not a super well-managed company in the 3D printing space that I can think of. I think HP Enterprises has like a 3D printing unit. That's like a big company that's trying to do it. Or maybe it's just HP, just general. I forgot which one. There's like two stocks, but that's it. I mean, I haven't heard much development. I haven't heard much more results from this. And just like you, like I've been hearing about it for 10 years. So yeah, I've definitely burned on that one too.
Other concepts that, I really do think that, are obviously going to be big trends, driverless cars, right? Autonomous cars. Obviously Tesla is, leading that front. By the way, I'm going to make a shout out here real quick. And I got to say this, man, because it's something that I've been thinking about for a while. I really think that Tesla is going to be a less than, triple digit stock, like by the end of, next year, probably like this time next year. I don't know why, but I think Tesla has way too much competition. I think it's a very, very overhyped stock still. And I personally think it's going to go back under $100. I know that's a bold call, but what do you think about that?
I don't agree with it. I don't agree.
Yeah, I figured you wouldn't. I figured you wouldn't. Let's expand on that because, okay, my perspective is that I think that, okay, Tesla is definitely the EV leader. I think it's also the autonomous leader, but I don't think that it is properly valued, not only as a car company, but it's not even valued properly as like a tech, a growth, and autonomous vehicle company. And I think the valuation is extremely high.
See, I totally get that. You know, I've heard a lot of these arguments before, and definitely before the entire run up, the explosion, I was definitely in that camp. But how much revenue do you think Tesla is expected to make next year? Just the estimates. How
Um,
much would you say this company is worth? $650 billion. How much do you think this stock would make?
I don't know, maybe like 100 bill.
Yeah, it's expected to make $120 billion. That's about a 5 to 6 per like price to sales ratio on a growth scale, and it's growing sales by 40%. It's going to grow them 60% this year so far on track to doing that, and then 40% next year. Okay, it's going to trade at a price to earnings of somewhere close to be 50 and 60 next year. That's still much cheaper than a lot of companies that are growing their earnings, you know, it's expected to go 31%. When I'm talking to you about like next year is not going to be a growth environment at all, for a company to be growing that much, expected to be growing that much, that's great. And I know that estimates could definitely come down if there's a recession. Car sales are definitely going to decline,
Yeah.
but that just shows you the staying brand of this company. And not to mention the gross margins on Ford 15%, GM, I just checked them today, GM 13%. Tesla got a gross margin of like 28%. I think that's the number that came out this year. So they're making more profitable cars. I'm not the biggest fans of them, but they have that brand, and I think Tesla also has the route to like make its own app store on its own
I heard that.
car
Yeah.
device. Yeah, I mean they have so many avenues, and I think Elon, you know, I'm not the biggest fan of him, but he seems to be a guy I do not want to bet on. And if these numbers even come true, even half of what they come true in a slowing growth environment, I mean, I think it's one of the safest stocks to be in. And I know that's crazy, but like it is really like safety to me.
Okay, that's fair, and I'm kind of there with you. I think Elon himself has wrapped himself in this very sort of tricky persona, especially online, where he's kind of becoming like an enemy of himself. And I think that's one of
Sure.
the reasons why I wouldn't say I'm betting against like him or the company. I just think that the market could beat it up a lot more before we start to realize like, oh shit, Tesla at $80, Tesla at $70 is an amazing buying opportunity. And that could be a
Mhm.
factor of Elon himself. That could be a factor of recession. That could be a factor of more and more competition coming into the market. And obviously, Tesla is still, king of EVs, king of autonomous vehicles. But, I often see nowadays, like, okay, people are getting interested in EVs. The government itself is starting a program where you can buy EVs with a $7,500 discount starting next year, right? A lot of companies are probably going to start taking advantage of that, and they're going to want to, chip into that Tesla market share. So for me, the only path I see Tesla, again, this is only speaking for the 1 year ahead because of all the factors I mentioned. The only path I see for Tesla is like down from here. And that's a 50% drop in the stock price. But that doesn't mean it changes the fundamentals or the greatness of the company. I just think that this stock is going to get, hammered over the next year.
Okay, then let me ask you a question. If you think, let's just say it's going to make $100 billion this year, when do you think it's kind of going to peak in revenue?
Uh, Peak, I mean, that's a very hard question because I don't know what Tesla's future holds, right? Like whether it's the
Sure.
app store or fully autonomous
And
vehicles
yeah, that's
or
yeah,
these, trucks that they're trying to bring about. I mean,
exactly. That's my point. Uh-huh.
I
Yeah.
mean, I agree, right? Like, okay, they have a lot going for them, but I also don't question the market's ability to beat up great companies, especially companies that are roiled with management that is a little bit more skittish, or I would say causing a lot of chaos or disruption, especially someone like a personality like Elon Musk, right? I think that is where I'm looking at the stock and the company and saying there's just like way too much noise around this company, and I feel like the market has the ability to beat it up. It has nothing to do with what you're talking about regarding valuations, because you and I know very well that companies can stay beaten up. Good companies especially can stay beaten up for a long period of time where it makes really no sense to us. You're like, how the hell is this possible that such an amazing company is, down, 30, 40, 50% on the year, right?
Yeah, I totally agree with you, but they do have one thing that's different that that it and GameStop has in common. They have a crazy shareholder fan base. And if there's something that I've learned from that whole GameStop tourney is how much, even if your company sucks, even if the outlook sucks, if the shareholders are willing to hold on to it because they have that much passion for the company, which I think GameStop, I've seen it in Tesla. I don't know if I've seen it in another company besides those two. If they're willing to hold on to it and even buy more because of, one, obviously you and I are both in agreement, the CEO doesn't rub us the right way, but I think to some people he absolutely does. Like, they don't even care about the company, they want to bet on him. And I think when you have this allure, this share base that'll keep it up, I think there's a level of safety that I didn't understand from the GameStop tourney before. And GameStop is yet to break down. Like, it's been trading in a range for the whole year. And it's
It
crazy.
has,
It's crazy. You
yeah.
know what I'm saying? I mean, like, this is a company where the business itself is going out of business. The industry itself, hard copy games. I mean, it's just, never doubt that single factor. I think that is one of the most important factors in any stock, and very few stocks have them. And so I think, I don't know how much the market is going to humble it, because yes, I think you can get these events where, like, Elon is being forced to probably sell shares to buy Twitter, which is
That
like,
would
I
be a
mean,
big catalyst.
yeah, I mean, and that's why the stock has gone. It was $300 maybe 3 weeks ago, and now it hit 200 just last week. I mean, that's a 30% drop in like 2 weeks. And so, the market is definitely punishing it for that. But to see it break down to under triple digits, I don't know, man. That's going to take a lot.
Yeah, fair enough. Well, we'll definitely have to come back to this next year. I want people on this video to definitely save this tweet or save this video that I'm going to put out with.
Yeah.
Let's see. Okay, so let's try to wrap this up. I mean, a couple of other things I know you and I have talked about before. I think you had mentioned silicon carbide, right, as a new material.
Absolutely. Well, not new material, but one that was brought to the mainstream by Tesla. Yes.
Okay, fair enough. Yeah, tell me a little bit more about that. I mean, first of all, what exactly is it, and why should we care?
Well, I'm not a super expert on the material itself. I just know that it has a higher, like, capacity to conduct electricity at a much more efficient rate, which is why Tesla started using it in the first place. And when Tesla cars showed that they were a lot more efficient with this chip, I think it's only a matter of time before all these car companies are going to copy them, because that's what they've been doing since the beginning. I think Tesla is just leading on the hardware front, on the software front, and eventually the demand for silicon carbide is just going to go through the roof. I think it already is, to be honest. There was a company called AEHR is the ticker. They reported, I think this week, I forgot what day, but the stock is actually one of the best semiconductors in the entire market right now. And they specifically do testing for silicon carbide chips. They're like the applied or testing equipment for the silicon carbide chips. And so they are a pure silicon carbide plate, along with Wolf, WOLF, and onsemi is it's not a pure play, but they have a big portion of silicon carbide chips for autos. And I believe I think Site Time or Semtech, one of those two. Don't quote me on it. I'm pretty sure Semtech has some exposure to silicon carbide. These stocks are doing much better than, the likes of AMD or Nvidia or Marvell. Even though all of them are in really good growth industries, like data centers and things like that, the silicon carbide based stocks are doing well above the rest. So I think that's a confirmation that, once things start going, I think those are the areas you want to focus in, because that's the trend now. Silicon carbide, at least for autos, and I think that's going to push a lot of the demand much higher than any year previously.
Okay, that's great to know for our users to pay attention to silicon carbide. So I'm going to give you something along the lines of new materials, something that I read into a little while back. It's called graphene, and let me see if I can pull it up right here. Right, so this graphene material, okay, kind of going along the lines of semiconductor industry. It is trying to be part of that good conductor as a material for good conductors, but also they've talked about many other things such as using it in bulletproof vests or an anti-cancer agent. It's something
What?
that, yeah, it's really, really, transformative in that it could be something very, very useful. But the problem is, and by the way, as you can see, they talk about it has the ability to repair itself from damage. So really, really interesting stuff. I
What
only
the
read
hell?
it. I know it's phenomenal. Some of the amazing science things that come about when you're just looking for companies and ideas. But problem is that they don't know how much of the pure material itself can be extractable and from where and which parts of the world. So it's one of those things where like it could be the next sort of generation of oil, but like where do you go about finding it, and what country would you have to bomb to get it?
What planet? You might have to go to another planet to go,
I
you never
know.
know.
Yeah, we might have to go to Mars too. And
Bro, this
speaking of
sounds like
Mars,
an alien.
right? Yeah. And Mars is obviously, a part of this list that I have, in terms of like space exploration and what could be a sort of a next generation idea of companies to invest in. First of all, like what are your thoughts on space exploration as like a investable business or stock that you want to buy into?
Oh shoot. Investable, I ain't trying to invest in it, but I'm absolutely fascinated by it. I think we're gonna live in a world where Earth is mining different planets. I think we maybe in my lifetime I might see that. I'm just not. I don't know if we're going to end up seeing that. I'm not really that much invested into space exploration. Maybe different forms of transportation, maybe the next level of high speed transportation. I think there's companies like United and Boeing that have invested in this company called Boom or something like that that'll take you from New York to London in 90 minutes. Things that'll just increase the speed of transportation. That's kind of where I'm focused on from that area, but space exploration, no, I don't know.
Yeah.
I'm not ready to invest in it yet.
Yeah, I think I'm on the same page as you would, where I don't really know, first of all, like how I would go about exploring, or how I would go about investing in these companies for space exploration, because first of all, it's like such a new game, or
Oh yeah.
misunderstood like TAM, if you will, right? Because you have no idea what kind of interest, what the costs are, what the margins and revenues are. It'll take a while, but I think it's on my list of just something to watch and something that fascinates me, kind of like yourself.
Yeah, and I think it's going to be an industry that's dominated by only like a couple players because, like you said, it's probably going to be super capital intensive. I mean, unless the governments get their hand in it, which I don't know. I mean, you already have a company like SpaceX that's saying we'll do all the work, so
Mhm.
it's going to be something that might have that Boeing flair. Boeing was a great stock for so many years before they literally shot themselves in the head,
Yeah.
and became and everyone realized, okay, y'all are abusing this monopoly. You guys are a terrible company. And, no one wants to be your friend anymore.
Yeah, yeah. Boeing stock definitely, I mean, cratered, especially in this 2020 collapse that it had in the COVID crash.
Rightfully so. It should be much lower, to be honest. I mean, I hope I'm an Airbus dude all the way for
Yeah,
sure.
yeah, fair enough. So listen, I think this was a great conversation. I think we can probably wrap it up here. Is there anything else that you want to mention?
Um, I'm trying to think. Oh, another theme that I think is going to be very good over the next couple of years. You've already had the Biden administration kind of promoted. I still am a believer of clean energy stocks.
Oh,
Um,
ESG style.
yeah, I am. Even though the stocks are very volatile and the amount of winners in that industry seems to be becoming a lot more narrower.
Yeah,
But I would just stick to watching ENPH. I think that's a company that has institutional backing. It has really good technology, really good industry. I believe they are in the residential solar space. They make all these different materials that are becoming more efficient for solar energy. I think it's a very innovative company in the space, and as you see, it's gone crazy. But yeah, I think that's one that I would definitely look at. I don't know if now's the time to get in, even if you believe in it, because these stocks are a little bit pricier, but they're not in the same league as software. They're profitable. I'm pretty sure ENPH is let me check real quick how much ENPH is just on a PE basis. ENPH is going to be trading at like around 50 to 60 price to earnings next year, growing revenue is still above 30% with really good margins. So, you know, that's a company I would definitely keep my eye on if you want to invest in that sector.
Okay, perfect. Well, listen, man, let's try to do this again, you know, maybe later this year or early next year to see how the year closes out or what our ideas are, hopefully for, you know, headed into 2023. I think this was a fantastic conversation. Our viewers will get to look at this video and kind of get an idea of, you know, where we are in terms of the bear market, our strategies for the remainder of the year. And then, of course, you know, new technologies that we discussed, such as the AEHR that you mentioned, silicon carbide, graphene, Mars, all kinds of cool stuff. So yeah, with that, I'm going to leave you guys to it. Thank you, everybody, for watching this video. Make sure y'all hit the thumbs up. And until then, I'll catch y'all again in a different video, hopefully with Faisal sometime this year.
Peace.